Good morning to all. In today's session, I'm going to begin with the models of market structure in terms of monopoly and monopolistic competition. So let's begin with the monopoly. What was the conceptual framework of monopoly? Monopoly is that type of market where it is dominated by a single seller, where there is no different sellers in the market. Only the single seller has an authority to set up a price and charge from the different buyers in that particular marketplace. They form when the barriers prevent the competitors. There is no competitors in such market, and as a result, the cost, whatever the cost incurred to supply a market, that will take place in it. They also take an advantage of such the particular sellers will take an advantage of their monopoly power, and accordingly they charge the higher rates and the prices of the respective products in the market, as they are a single seller, so they have a full power to set up their price, which would be the high price, and accordingly they charge to the different buyers. But as far as I'm concerned, in the United States of America, such monopolies, a single monopolies, are actually illegal in that particular country. In India, it always been exists. So there is a one of the government related example, the particular organization income who has exist as a monopoly, and they have a full authority to charge the affordable and the high prices to their customers, to their buyers as well in that particular monopoly market. So let's look at the example over here. This is an example where the monopoly power is still exists in India, that is IRCTC. It is a state-owned company and is the only Indian markets who are operating within this industry. And of course, it is absolutely a monopoly since customers have left no with choices, no alternatives that where they go to reach to the different states within the Indian territory. This company is mainly established in 1845, and globally it is one of the largest railways and the largest employers in the world. It's not related to the tourism industry, but is also related to the hospitality industry as well as the nursing sectors as well. Let's talk about the features of a monopoly market. So this is a chart where exactly the 6 features of the monopoly has been shown. So let's begin with the price maker. When we talk about the price maker, monopoly firm has a full authority to set up a price, and accordingly they could charge the prices or cost to the different buyers, and accordingly they will set up that particular price which will be charged to different buyers accordingly in that particular market. When we talk about the barriers to entry, that's true. There is no competitors. There are always barriers that are new competitors or the new firms cannot be possible to enter into such market, as it is a monopoly. A single seller would exist, so there is no place of any of the seller who can enter into such market, and accordingly they can set the prices and charge to the different buyers with their respective products. When we talk about the demand curve, in case of the monopolistic firm, the demand curve is almost a downward sloping. So it's always from the highest peak to downward. So whatever the curve which begins from the origin or which begins from the y-axis, it always slopes downwards, and that is the shape of the demand curve in case of the monopolistic firm. There is no close substitutes of any of the products. Whatever the product sellers offers to the buyers, and at that particular price will be already set up a pre-decided price, and accordingly they will charge from the, you can say, perfect substitutes goods. When we talk about the full control over supply, it has a single seller, and of course they have a full control over the supply, over the cost of production, and in fact about the productions of goods to the different places or to the different states within the particular India. So that is the case of the monopoly where they have full control over the market. Whatever the supply cost, whatever the prices they would charge, they have their own control to set up and charge accordingly in the market. The last feature of the monopoly market that the firm itself an industry. Definitely, in the market, it is a single seller. Automatically, they have a full, you can say, control, and they act as they act itself as an industry in that particular marketplace. So these are the six main features of the monopoly, where a particular monopoly, a monopolistic firm which exists in such particular place. Now we talk about what are the reasons for the existence of the monopoly. When we talk about the existence of the monopoly, that there are the various reasons where this particular market could easily exist. So the first reason is such monopolies have a significant market power. They can restrict the quantity sold in the market. They can immediately rise up the prices beyond the competitive level without losing customers, because as the customers have no alternative in choices to refer to the another market and buy the product. So whatever the price is set, whatever the demand of the customers comes in such particular market, they have to buy that particular goods at the set prices, whether it would be the high, whether it would be the low prices. It's in respect of the perfectly competitive market, or as compared to the perfectly competitive market. In this particular market, that you can say a monopoly market in, so where the consumers, you can say, less likely to harm, where the consumers does not harm in any way in terms of the prices, in terms of the products. After all, they know there is only the seller who can provide us the maximum to maximum products for the survival. It also prevents the competition. As in such market, there is no competition, so automatically there is a monopoly market. These monopolies are definitely offer a product which always have an agreement between the one company and the customers of another. So in such particular market, whereas they have a full control over the market, they act as an industry in itself. So such markets, such monopolies offers a product which set up an agreement between the company and the customers of another companies. So whatever the products they are dealing, it's not related to its own customers, it also related to the company clients, company customers to customers. You can see a C to C as well, where such market which easily exist. When we talk about the second most important reason is the natural monopolies. It always occurs when any of the single, you can say, organization you can say, serve a whole demand exactly. When a particular company, there are thousands of employees, they automatically demand in itself a huge demand, the whole demand of the products, and the monopoly firm has to serve that or fulfill that whole demand. That is the main reason the monopoly market exists in case of natural monopolies. For example, if in this particular country, the Nestle company would exist and there are plenty of the employees, or you can see there are plenty of the companies who have a plenty or thousands of employees. If the Nestle company exists only, they have a monopoly market in all over India, then automatically the Nestle company has to fulfill the whole demand of all of the employees of this particular different organization in India. So automatically it's actually called the natural monopolies, where only the company, only the one company will fulfill and serve the whole demand of its whole customers in India with different respective states. It also implies that there is the competition which never exists in such market in case of the natural monopolies as well. And if there is a little chances or the 1% chances of competition, that means it's totally inefficient. So in such case, the monopoly are more likely to have to have a proprietary information. That means they have a little information about you can say their customers. So in fact, they are more likely to set their prices than the competitors. So whatever the prices they will set under the natural monopolies, where only the one company or the one organization exists to serve the whole demand of its whole customers in India in the different states. So that's exactly called the natural monopolies. We can talk about the Nestle, we can talk about the Dabur, we can talk about the organic farming products who existed all over India. Along with the, you can say there is no, especially the organic farm products is available. You can say any other company would exist properly as the organic company, which is always exist as a natural monopoly. And then ultimately, they have a full power to increase the prices, and of course, it limits the competition level among the others. So this is all about the reasons for the existence of the monopoly market. Now, what are the sources of the monopoly power? So, when we talk about the monopoly power, where a particular single firm has a full authority or a power to set up the prices, to arrange the cost, to supply the goods and services to its customers, but automatically there are various factors which automatically influence such monopoly power. The first reason is the barriers to entry. And automatically, when we talk about the barriers to entry, so if something that a very good you can say firm would like to enter into such market and approach to its customer, but unfortunately there are barriers to entry. There is no entry and exist in such particular market. Competition number, as there is no competition, so automatically it also influence the monopoly power. If there is a chances of having a competitive level among the others companies, if other companies could exist in the monopoly power monopoly, then it's not called a monopoly. It's totally convert into the monopolistic competition. When we talk about the advertising, of course, monopoly, a single firm has to advertise their products to the different, you can say, states, and approach a promotional activities or the strategies to advertise their own product. But unfortunately, if the advertising cost wouldn't be incur or wouldn't be, you can say, consider, you can say in case of monopoly, then in that particular case, advertising is also influence the monopoly power. When we talk about the fourth factor, that is the differentiation of the product's characteristics. That's very true that there are the plenty of the products types. It would be the consumer products, it would be the luxuries product, it would be the durable products, it would be the non-durable products. So the product characteristics and with their different varieties of it automatically influence the monopoly power. After all, there are a plenty of the products where a single seller has to deal with it, and accordingly they have to sell that products to its own customers or the company demand of its customers to customers. So it would be a handful. Such variable would also become influence to such monopoly power as well. If the higher cost or the higher barriers would be possible, that means the monopoly firm would be a more powerful. That would be a one of the influence uh, factor which occur under the monopoly power. So if there is a higher cost, there is a, you can see more and more barriers to be put on to enter into such the market. It actually means the power of such monopoly firms are so stronger that no one can even take a chance or take a risk to enter into such market. When we talk about the next six factor, that means that as there is a very less competition in the market, that means the power of the monopoly would also become higher. That means if there is very less competition, the monopoly firm have a more power to work into such market place. The more advertising means the more investment, the more risk, and of course it automatically generate or convert into well brand name. If it happens, then automatically the monopoly power will become higher. So that means the advertising cost is also one of the factor which influence the monopoly power as well. That means it automatically increase the power of the monopoly if the single seller want to invest more and more on advertising. Automatically, when we talk about the last factor, is there is more and more differentiation of the products in the market, in the single market. That means there is a more and more greater magnitude of, you can say that more and more variations could be seen in the power of the monopolies. So these are the, you can say, the seven factors which ultimately influence the power of the monopolies market. So these are the main sources which you can say these are the key points, and you can easily elaborate these key points which automatically influence the monopoly power. Next concept is monopolistic competition. When we talk about the monopolistic competition, it's just like an open market where the large number of buyers and sellers are open to sell their products. They are actually a similar products, but not you can say identical. So it's automatically this is the one of the you can say market, one of the type of the market structure where the plenty of the buyers and sellers who come into an open market and they sell their products and services which are in similar nature but not identical in nature. So that type of market structure or that type of market is actually called the monopolistic competition. Now we talk about the four, you can see the conditions of the monopolistic. The first one is automatically the many firms. When we talk about the many firms, then market, monopolistic market does not have a high startup cost, and of course they have a more and more firms to enter into such particular market. When we talk about the barriers to entry, there is actually very low chances. Even the new firms can easily enter into such market with their high startup cost, and the more and more firms would enter, then automatically the competition level would also become higher in this particular type of the market. So these are the first of all, these are the two main conditions. Then we come up with the next two more. And there are many firms who are exist in such market. They have a full freedom to control the market in terms of buying and selling of its own products to the different buyers. When we talk about the next is few artificial barriers to entry, that means the barriers to entries are relatively low as compared to the monopoly market. So automatically the new firms can easily enter into such particular market. That means in monopolistic market. Next condition is a slight control over price, and ultimately the firms, mostly the different firms in such particular market, have a freedom to rise prices because each firm charges, you can say, a little different price from different consumers. So in this particular case, the price discrimination situation would always exist where the monopolistic has some little freedom to charge their own price to the different consumers, whether it will be the low or high to from anyone else or everyone else. That is the third main condition of monopolistic competition. That means a slight control over the price. When we talk about the fourth condition of such market, that is the differentiated products. Automatically, when we talk about the differentiated products, if there are plenty of the farms who are selling their products, but that products are actually differentiate, we can differentiate, distinguish from one product of one farm to the another farm products. So that means it's called the differentiated product, and every product of any firm would differs to another farm products. So firm has some control and have little freedom to set up the price and charge accordingly, but their products are actually differentiate, or you can distinguish their products from the other products which are actually available in the market. So these are the four conditions, main conditions of the monopolistic market. The first one is many firms, barriers to entry, a little little control, little barriers to entry. The next one is the slight control over price and the differentiated products. So these four conditions, if any of the firm fulfill, then definitely it already enter or having in the monopolistic competition. What are the types of businesses are monopolistically competitive? So there are actually various types of the businesses which have a monopolistic, you can say, competitive markets, and of course there are most markets were exist in this particular model. If we talk about the soft drinks, let's take an example of the soft drinks. We always talk about the Coke, Pepsi, RC, Pop, and many firms. There are plenty of the firms if we talk about which already exist in India. We can talk about the Coke, we can talk about the Pepsi, we can talk about you can say the Red Labels, Red Bulls, you can say products. So there are plenty of the firms who are actually involved in the soft drinks which are not exist in India, but it's also take over or take a next level to the international level as well. So that's why it considered as a monopolistic competition or the monopolistic market. There are some, when we talk about the few, in case of the soft drinks, that means the barriers to entries are actually or relatively very few. That means they don't need any huge factories to open up the soft drinks factories. There is no chemicals to be used, and relatively such soft drinks are actually very inexpensive to produce. If you look up any of the soft drinks in India, it's very, you can say, affordable to every section of the society in India. And that's the main reason that there is very few barriers to entries when it comes to start up a factory. So definitely it would be a barrier at all. A chemical industries or chemical products, it could be a barriers to entry when we talk about the any new medicine enter into a market. That means you can say a few barriers to face off that particular company or the firm. So automatically, in case of the soft drinks, when we talk about the barriers, there are very few barriers when they open up any of the factory in India, when they actually have any chemical usage. Then we have a very few artificial barriers to entering such particular soft drinks companies, and of course everyone can easily purchase, or it is uneasily the companies could easily produce such products to the different countries or at a very affordable and nominal charges. When we talk about the comparison of the differentiated products, that means the Coke and VPO. VPO is actually, you can see the one of the virgin of the soft drinks, and obviously it is another firm who involved or entered into such market, and of course the competitor of the Coke as well. So it is also soft drinks, are colored soft drinks where the people, or you can see the international, or you can see clients or the customers prefer such particular soft drink as well in their daily life. So automatically, if we compare the differentiated products that Coke is compared to Repo, then automatically there is only a slight control over the product. Means Coke is little more expensive than the Vipo. Vipo is actually the cheaper product, which is a very colored soft drinks. If you look up in India, there are very soft drinks which is in color like Red Bull, we can say energy drinks, we can say. So automatically, when we talk about such drinks and compare to the another drinks, that definitely there is a, you can see, slight control, a little increase or decrease in prices or the cost. So that is also the one of the condition which has been fulfilled in case of the soft drinks under the monopolistic market. Some people like Coke more than Pepsi. That's very true. It's a differentiated product. Get the preference of the customers that and the choices that which product actually they prefer more. So in this particular example, the Coke, some people are actually prefer Coke more than the Pepsi, or some people prefer, you can say Pepsi more than the Mirinda. So that is actually the some types of the businesses where the monopolistic competition you can already exist, and already it is exist in real terms as well. How do firms in monopolistic competition get customers? What are the reasons that how the firms would easily get customers in this particular market? It totally depends upon the level of styles they apply, the level of services they offer. It depends upon the location. It also depends upon the environment. It's totally not depend upon the high and low prices of their differentiated products. Of course, through the non-price competition as well, a particular firms has to focus on their style, services, and location as well, so that they can attract more and more customers in this particular market. So, of course, the non-price competition is actually not enough. There are other parameters where the every firm has to focus upon it. It's not about only charging the lower prices and accordingly they will grab the market, instead of having more and more competitors and rivals in the market. Now we talk about the four types of non-price competition. Here in the previous slide, I always talk about the non-price competition where we are always focused about the services, style, location. It's not about only the lowering the price. It also talk about that what characteristics of the products you actually refer to offer to its customer. What would be the location? It would relate to the rural, or it would relate to the rural urban, or it would relate to the exactly urban when it comes to the sales of products and services, which should be differentiated from its customers. So that is also important when it comes to the non-price competition, when price is not only a reason to attract the customer. There are also the other parameters. That is, one of the parameters is the characteristics of the goods. The firms automatically differentiate the products not based on the size but also color, shape, texture, taste. If you look up that in the various shopping complexes, there is a workshop or there is a stall has been affixed to taste a new product for its customers. To launch a product before that, they just make the taste to the different customers how the taste would be. So if it is something different, then automatically it would work and the sales accordingly would initially would goes up if it is liked by the customer, if the taste has been good and preferred by the customer. And automatically that is also considered the characteristics of the goods where the different firms can be distinguished their products through the various you can see characteristics, that is the size, color, shape, texture or taste. If we look out the if we comparison the two goods or the three goods in the market which is available, we can talk about the Coke and Pepsi, as many people prefer Coke you can say rather than Pepsi. We can talk about the here in this the Diet Coke, another version it come a lemon Pepsi and a Diet Coke. So the Diet Coke is more preferred than the lemon Pepsi in India by the you can see its customers. Vanilla Coke is also come up, which is something a new test, a new particular frame of taste has been come up, which has been launched by the company. So this is the exact new variants where the particular firms can easily distinguish with its own products. Next one is the location of sales. So when we talk about the location of sales, a convenience stores always it you can say it would be the rural region, it would be the desert region. If any of the convenience stores would exist in the desert region, that means the farms can easily distinguish by its location. So it would be it's totally distinguish or differentiate by selling it miles from the competitors. So it would be, you can say, one of the type of non-price competition where the price has no role, but the location is very important in how you build up your sales for your own products in that particular desert area, and it automatically differentiate from selling from its own customers, own competitors or rivals. That is also the second factor or second type of the non-price competition. Now we talk about the third type of the non-price competition, that is the service level. So when we talk about the service level, the some sellers can change or charge the higher prices because they offer customers a high level of service. That means if you increase the level of your services, so definitely you have to invest more. You have to charge the higher prices to its customers. For example, a fancy sit restaurants, it's more expensive than the McDonald's. So if you can look up the service level of the McDonald's, it's very cheaper when you reach out from the fancy type restaurants or the luxuries restaurants where the various varieties of the food meals or the meals would already exist. So automatically their costs are more higher than the McDonald's. So then the products also variants to each other, and the customers can all easily distinguish between the products of the fancy sit-down restaurant or the McDonald's. So McDonald's is mainly known for the junk food, but when we talk about the restaurant, it's all about the main course of the meals. So that is the level of the services. If the customers expect the high level of services, then automatically a few or some sellers can charge the higher prices. So we can compare the McDonald's and fancy sit-down restaurants. Now we talk about the advertising image. So when we talk about the advertising image, so automatically advertising it always creates an appealing image in the minds of the customers, and it will set up a different level of you can say image in that particular marketplace. So automatically, when we talk about the advertising, so advertising create an appealing differences between the products in the market price. So when we talk about the market price, so advertising automatically plays a significant role and always capture a particular you can see an image in the minds of the customers, and based on the image they can come up in the market and buy such products. So advertising is also one of the type of non-price competition where the price has no rules. So be done by the customers only. So customers has full freedom to compare the two different brands of the shoes, and accordingly they came to know and they can easily differentiate by their advertising images as well. So the more appealing the advertising image, definitely the customers would go to that brand first rather than the secondary brand or the second brand. So advertising image is one of the type of non-price competition. So this is a distinguish between the monopolistic and the perfect competition. So when you talk about the monopolistic, the prices will be the lower and firm have no control in such market. When we talk about the monopolistic competition, so automatically the prices are little higher than the perfect competition because the firm has some control over the prices, over the market as well. When we talk about it, how much the profits the firms would earn actually in this particular market structure. So when we talk about the perfect competition, profits are actually lower, but in case of the monopolistic competition, higher in the short run period, but in the for the long time period, the firms have to work hard to keep their rivals to be less known about your you can see the stronger you can see your monopolistic power in that particular marketplace. So automatically when you increase in the monopolistic, the profits are major higher in the short run. And if we talk about the long run, the all firms have to work hard and just take the top position as compared to its competitors or rivals. Next, we talk about the cost and variety. So when we talk in case of the perfect market structure, the low cost is always involved in it, and of course there is no variety or the variants of the products. All are identical products. When we talk about the monopolistic, higher cost would be for the differentiated products, and the comparison could be easily exist by the customers. And of course, when we talk about the product differentiation, there are a wide varieties of the products of different companies, brands, and the customers as accordingly buy. And this particular market is exist in India. We can talk about The milk is milk is not for Mother Dairy. It's also for Amul. It's also for the other brands. So automatically, the higher cost for the differentiating products, and there are wide varieties in the market. We can talk about the Cyrus milk. We can talk about the Mother Dairy milk. We can talk about the Amul milk. We can talk about the Counting Delight milk. So these are the various brands, various companies available, various labels are available, and automatically the higher cost would be chargeable for such products, and the variants that actually are more in this monopolistic competition. The next concept is oligopoly. When we talk about oligopoly, it means it's that type of market structure where there are only the few, there are only a few sellers which would earn, you can say, a large profitable in that particular marketplace. So oligopoly is that type of market where there are only a few sellers who earn, you can say, maximum profits in that particular marketplace, and that is called the oligopoly. How the oligopolies work. So there are the various reasons for it. And of course, this type of market structure, this type of market are also illegal in US. But when we talk about the how this market would work, the first reason is collusion. Second is price fixing, and the third one is cartels. So when we talk about the collusion, there is always an agreement among the members of the oligopoly to set up the price and the production levels. So when we talk about the agreement and how between the two members or the two members of the various companies. So when the agreement has been you can say occurred in terms of setting up the prices and the production levels. So such type of agreements are actually illegal where the members of the oligopoly firms are ready to set prices and the production level, which is which is absolutely unacceptable in such particular market. And that's the main reason that in US is actually illegal. So there is no agreement would exist, but in other countries like European countries, Asian countries, this collusion will always exist. When we talk about the price fixing, that is also the one of the way where the oligopolies would work in their exact marketplace. So it is also price fixing can also done by setting up an agreement among the firms who are ready to sell at the same or the similar prices. So when we talk about the same prices or similar prices, that agreement has to be fixed among the firms, that is really unacceptable in this particular oligopoly market. So that is why that these two main, you can say that how the oligopolies work because of the collusion, because of the price fixing, and both are actually illegal in US, but it's applicable in all other countries. So it depends upon the requirements, you can say, and the preferences of the different firms, that how they make up an agreement to collude among the members of such market and just work together, you can see, towards setting up the prices and the production levels, and in the same case or scenario of price fixing as well. There is always an agreement exists among the firms that how you sell your products at the same or the similar prices in this particular segment. When we talk about the cartels is refers to an association of producers which we established, which is their main purpose is to establish and coordinate the prices and production. So when we talk about the join together to work, being as a you can see the producers and the sellers to coordinate the prices and production. In this particular cartel cartels, that there is no point that they focus upon to set up the price and the production level. There the firms are coming up together, established easily, and how they coordinate the prices and production together. That is actually cartels, and cartels are the most you can see the most relevant association which exists in India. There are various companies who are jointly work together and how they coordinate the prices and the production within Indian market. And one of the reasons is OPEC. OPEC stands for Organization of Petroleum Exporting Countries, who not only control the supply of oil but also manipulates the prices of gasoline. So OPEC is also the one of the example of the cartel who are very well established in India as well, where the you can see the companies of not only Indian companies, they can easily associate with the companies of international. They work together, how they coordinate the prices and production. Accordingly, they control the prices of oil and manipulates the prices of gasoline. So accordingly, you can check on it how the prices of the diesel and petrol goes up and down, how the gas you can see CNG gases, PNG gases, the prices is easily manipulated just because of the you can see associations of the producers, that how they coordinate the prices of the oil and gases, and of course its production levels. When we talk about the one of the international brand, that is De Beers. De Beers, it stands for selling and purchasing the diamonds. When we talk about the US, in De Beers is almost controlled the 80% of the world diamonds. How they keep up their prices limits are high, and how they coordinate the prices and the supply, and accordingly they limit the supply of the diamonds by immediately charging the high prices of it. And that is called the one of the international brand, that is the diamond brand, that is De Beers. And you always set up that how always set up a price which would be high by limit the level of supply. So that is also called a cartels, one of the example of the cartels, that how they work together, devious, how they devious is collaborate with the other diamonds brands, and how they coordinate the prices and the supply of that particular product. So this is a way that how the oligopolies work in terms of pollution, and how they make up an agreement on the numbers of the such market to set up the price and production. Same for the price fixing, how they sell up at the same or the similar prices. Cartons, how they associate together to coordinate the price production. And one of the good example of cartel is OPEC and the DPS. Now we talk about the market power. Here we are talking about not monopoly power, no oligopoly. Here just market power. Market power refers the ability of a company that how they control the prices in the output of a particular product. And the markets are actually dominated. It's not only for one or the few firms. There are plenty of the firms that through which the market will become dominated, and accordingly they can charge the very high prices and ultimately having a lower output. And once they charge the higher prices and the lower input, that actually it sends a great market power. It doesn't mean when you charge a lower prices and getting a greater output, but ultimately it's not a power actually. Once you charge the higher prices and the lower output, that would be the great power, and ultimately the profits would get double in case of monopoly and oligopoly. Because as their monopoly is single firm and the oligopoly is you can say smaller firms or few firms in that particular market. So when we talk about single firm, it doesn't have any influence because they know we are the only one in the market, and every customer will buy from us, from me, from us only, from a single firm actually. So that is or a few firms. So that is actually called a great monopoly power. But when we talk about the markets which are having a many sellers, many firms, when in case of the monopolistic and the perfect competition, then automatically they could turn up into a lower prices due to the high competition level, ultimately leads to the higher output. Then automatically when we talk about the market power, then how much control you have in the market, that in this particular scenario, in this particular case, a little or no market power would exist in case of the monopolistic and the perfect competition. So in case of the monopoly and oligopoly, even the higher prices leads to the lower output, and ultimately they have a great market power just because of a single firm or a few firms. But when we talk about the monopolistic in perfect competition, the competition are quite high, and due to which they will sell the product at a very low prices, which leads to the definitely the higher output. But it would be as is case there is no market power. If it is a power, then of course it is a little market power in that particular markets. That is monopolistic and perfect competition. So this is how the market power works in it. Now we talk about the pricing. That one of the times where the price plays a very important role in how it would work in the monopolistic and perfect competition. And one of the pricing type that used in monopolistic and perfect competition, and firm use it actually, that is called the predictory pricing. Predictive pricing is one of the type of pricing where the firms set up the market price below the cost level for a short term to drive out the customer, just to you can say just leave that customers or just remove that customers competitors into the market. So that is called the predictory pricing. When we talk about in this way, the firms in monopolistic and perfect competition actually gain the market power. As I told, that there is no market power or very little market power, but through the predictive pricing, when we set up such price which is below the cost level for a short-term period, just to take out the competitors into the market. And as a result, in this particular setup of price, at least such markets that is monopolistic and perfect competition will actually gain some monopoly power. For example, it's shown over here that there is a pizza shop who sells the slices of pizza of dollar 0.50 each, and of course it cost me as a customer it's 0.75. That means 20.25. That shopper, the pizza shop, is actually loses that money, and ultimately the competition level is automatically out of the business as it rise the price later. So automatically when you sell that particular slice at a very low cost, but actually it cost is $0.75. That means that shop owner of pizza is losing 0.25 as they set up the price, it's below the total cost. And ultimately they out of the such particular shops is out of the business, and they will plan to rise the price later according to the particular situation. So this is an example of the predictive pricing where the exact market price is below the cost levels for the short term period, and that is actually called predictive pricing. And this is a way that how the monopolistic and the perfect competition will gain the market power somehow, so that the other competitors or rival would be out of their business, and they will plan something new to rise their prices for its own products, as you can see in this particular example of the predictory pricing. Now we talk about the government and competition. There would be a four main types of the competition. Of course, the government plays a very important role in it, because in this particular markets, of course, the rules and regulations will always exist. But some markets would never follow such rules and regulations, and they charge the prices accordingly in the marketplace. So government will always try to keep up the farms from controlling the prices and supply of important goods only. And that is the main reason that farms has always government has always tried to make the farms to control their prices and supply just only for the important goods. And on that basis, the antitrust laws are actually built up by the government just to encourage the competition and break up the monopolies and oligopolies in the marketplace. And government is always try to avoid such markets which is called the monopoly and the oligopoly markets, because some of the activities like collusion, price fixing, that is illegal activities where the government will always restrict to such activities, and due to which the antitrust laws has been implemented to encourage the competition, break up such market, and turn into the perfect and monopolistic markets in India or in that particular marketplace. So that is the major role of the government, and how they keep up the farms to control the prices and just supply whatever the important goods they can able to offer in the market. And due to which such laws has been developed to encourage the level of competition would be high, and accordingly they will break or remove such markets like monopolies and oligopolies in that particular marketplace. So this is all about the government role in these particular markets and what laws they have made up. That is the antitrust laws, which is being set up in this for the sake of the firms who belong to the monopolistic and the perfect competition, and rest of the market would be out in that particular marketplace. There are four forms of antitrust laws. The first one is regulating the business practices. The second one is breaking up the monopolies. When we talk about the regulating the business practices, so here the government is always interferes when the firm has too much market power. In case of the monopolistic or perfect competition, then the government has a major role that if the firm has too much market power in that particular marketplace. When we talk about the second type is just to break up all the monopolies and oligopolies in that particular marketplace. And that's the main reason the antitrust laws has been used to break up such monopolies. For example, Standard Oil, AT&T. The third one is blocking mergers. What is merger? Merger is a combination of two or more companies into the one firm, and how the government will block such competition and such mergers if there is a decrease in the competition. If there is a decrease in the competition, decrease in the firm, then again they turn up into the monopolies. And the government will always try to block such monopolies, markets, and oligopolies in that particular marketplace. So that's the main reason a merger is also the one of the type of the antitrust laws where the you can say two or more companies turn into one firm, and the government has more involved to block such mergers who turn into one firm, and again they will become a single monopoly. So that is also the one of the law. The next one is preserving incentives. When we talk about preserving incentives in 1997 is always a new guidelines has been circulated by the government in case of the mergers, and where the mergers you can say were introduced. That means that merger would be introduced if they provide and show us the benefits to the consumers. Mergers can exist if they provide benefits to the consumers, and those mergers will they're always blocked if they don't show anything or do or no benefits to be provided to the customers, and of course or also they decrease the competition in the marketplace. So preserving incentives if such mergers provide benefits to the consumers, then mergers would always introduce to allow companies to merge. So that is also the one of the law where in 1997 onwards the mergers concept has been introduced where the government has allowed the company to merge. It's deregulation. Deregulation means just remove of some government controls over the market so that the competition level it should promote more and more. Deregulation always allow more competition. It means it refers to more competition in the market. That means that more competition in the market. That means the prices could become lower and the varieties of the benefits would become greater. And automatically, of course, the business deals would goes and off. It could turn into the positive or negatives depends upon the changes that occurred into the market. Let's take one of the example is the airline regulation in the early 1980s. In that particular period, there are smaller or cheaper airlines emerged, but the older and the larger airlines having a trouble competing. That means there is a issues that arise at that particular period, and automatically they have to cut back the flights, employees, and benefits in flight meals as well. Why? Because the benefits are actually high and the costs are or the prices of the tickets of such airlines is lower. And ultimately, a trouble exists when they have to cut off the something the on-flight tickets immediately. The employees they have to fire, and of course, the benefits of the to the customers has also become low. That means the means which is provided at that time in the airline, it's just cut off that in-flight meals as well, and that's called the regulation. Why? Because of the increase in competition in the market, and ultimately when the airlines have a lower prices and the benefits are low, then automatically for a long period of change they have to make a certain changes which provides the benefits to its customers. So that's it for today of all these topics which has been taught in this particular session. I'll come up some more interesting and new topics with their diagrammatic representations in respect of the few more important concepts in the next session. Till time, thank you for listening the lecture and namaste to all.